So for now, we are going to talk about the case of tax incentives, and this is an important panel. So opening up the opportunity for all Americans to build wealth, tax incentive from the CfPA policy platform. We have some panelists, and we have a moderator, Andrew Dix, is going to come and talk about our guests and host this.
Thank you, Scott. Thank you, everybody who is here today. This is an awesome event. My name is Andrew Dix. I am the founder of the Crowded Media Group, and we are the publishers of Crowdfunding Insider. I've been covering crowdfunding for what seems to be eons now. And so we've been following this around the time that the Jobs Act was signed into law, and seeing all its ups and downs. We also cover the full stack of fintech. So today we're going to be discussing a really deep topic. It's one of my favorites. It's tax exemptions for private securities offerings or online capital formation or crowdfunding, whatever you want to call it. And we have, once again, a panel of experts that's going to share their wisdom with us. And I'm going to ask each of them to introduce themselves because they will do a far better job than I ever will. So I'm going to start with the OG there, Woodie. If you can tell us everything you've done in about 30 or 40 seconds.
Testing. Okay. Hi, Woodie Neiss with Crowdfunding Capital Advisors. I am one of the early advocates after Jenny on this whole industry. So it's really exciting to see it all come together. I was actually just looking at my email at the inception of the CfPA on April 17th, 2012. So congratulations to all of you who have gotten to this level. I look forward to seeing what it's like in another 10 years. Crowdfunding Capital Advisors and C-Clear is our data arm. Yvonne's my partner in that back there. We work on policy, research, data advocacy related to the entire industry. We work with the World Bank, the State Department. We've traveled around the world, worked in 42 countries, helping them build crowdfunding ecosystems. Got the entire Saudi Arabia crowdfunding ecosystem up and running, was our most recent one. Yeah, deeply involved, very much in the making of a Kool-Aid, and fully believe in it.
Thank you, Woodie. Marne.
Hi, I'm Marne Marotta. I'm the managing director at Arnold & Porter, and I am one of the staffers that worked on the original crowdfunding legislation, the Title III of the Jobs Act. I'm very happy to be here and so excited to see where it comes.
And I mentioned that I run a little media and event company called the Super Crowd, but 25 years ago, I launched an investment banking firm. It was a FINRA registered, at the time NASDAQ registered investment banking firm. Our very first client was a company setting up a crowdfunding site, a portal. And of course, that was 15, 16 years before the regulations caught up. The technology was obviously ready, but the regulations were not. So it was, my roots in this space actually go pretty deep. I'm not like some of these guys that. Anyway, I'm excited to be here. Thanks for having me.
Thank you for being here. Okay, so to kick things off, I will explain that one of the reasons I find this so interesting is the UK launched before the United States with regulated crowdfunding. And I quickly learned they had some interesting tax exemptions there, or schemes as they call them. The two most important ones are the SEIS and the EIS. And what it effectively does for investors in these private securities offerings, if you say, for example, under SEIS, you invest £1,000, £10,000, you get half of that money back immediately off your taxes. And I thought, well, this is pretty cool. And in all honesty, I'm not a big supporter of subsidies because effectively you're subsidizing an industry or sector or private companies. But I think if you support anything, supporting innovation, entrepreneurship, and opportunity is something you should do. You should at least look at. So I'm going to start. I'm biased. I support this thing, but I'm going to ask the panel their thoughts on is a tax exemption the right thing to do to support Reg CF and maybe Reg A, maybe Reg D 5 or 6C. I don't know. So we're going to start with the experts. So I'm going to start with you, Woody, and go down the line here. So tell us, what should we be doing here?
Well, I'll just tell you, as we go around the world and talk about this, tax credits and tax exemptions are part of what policymakers are putting in place globally. So the fact that we're lagging in that, I think, speaks volumes that we're behind the world in a lot of what other countries are doing in this area. I think this is something that could really help propel the industry. I don't think it's a one, solution fits all, but I think it will drive more people in, because I think what it does is it de-risks it for the investors. It lets them know that the government's going in on it with them, and you can actually write off part of it, and hopefully that will drive more people to come in and be like, you know what, at least I can write off half of it if the company fails. Of course, if it succeeds, that's great as well. But I just think it's something that we should have had at the beginning. It's something that we need to have, and I'm happy that the CfPA is pushing forward policy related to it.
Marne, so we can blame you since you helped to write the legislation as well. And Woody just said, we could have included this in the beginning. What were you thinking? I mean,
So many thoughts, right?
good Lord, everybody had their hands in it, so you could have snuck it in there or so long. I mean, nobody would even notice it. So why didn't you do it?
So I will say, going back, when we did crowdfunding, and Woody and I were just catching up on this a little bit, but when the legislation came together, it was a very innovative bill. It was one that we were pushing very hard. And importantly, it was one that was moving pretty quickly once it started moving. And there were a lot of state regulators that did not want to see this legislation move. And there was a lot of things that we had to do to just keep it going. Part of why there wasn't a tax incentive in there is that you have to pay for it in legislation. So you have to have Right. I think those are the rules, so we play this by. So it wasn't something that we thought was possible at the time, and quite honestly, we weren't thinking about it at the time. That was the innovation we were looking at, but it's certainly a great idea. I think it does de-risk the investments, and it makes a whole lot of sense for a healthy, innovative ecosystem.
Okay, so you mentioned an important characteristic there. It does de-risk the investment to a degree. So, Devin, I know you support this saying, but why? Can you explain to me why you support it?
Yeah, I'm excited. Very succinctly, the CfPA proposal is to give everyone a $1,000 tax credit for making at least $2,000 of Reg CF investments. It will apply to every American, period. Okay, so last year, there were 300,000 people who invested under regulation crowdfunding. Imagine if they had and they averaged about $1,000. This is broad approximation, right? But ballpark. Imagine that it was not 300,000. Imagine that it's not 3 million, that it's 30 million, which would be a pretty small percentage of the people that are eligible. And imagine that instead of investing $1,000 each, they invested $2,000 each on average to get the full tax benefit. The size of the industry would go from about $300 million in capital raise per year to about $60 billion in capital raise each year. Do you get the sense of scale here that we're talking about? This is huge in its potential for shifting the industry and making this work as it should, right? This should be the way most businesses are financed. And wouldn't it be great if it were? What if it were? Just begin to imagine communities owning the businesses that surround them. Imagine everyone prospering together. This is a crazy world that we're building. But join us in building it. I mean, my gosh, this is so cool.
Okay, so we don't have too much skepticism on this panel. I think everybody sees this as a good idea. Reflecting back on the UK, the one good thing about being able to point to somebody else who's doing it now is they actually publish data, believe it or not, so that you have some empirical information on what's going on in this jurisdiction, which is considerably smaller than the United States, but they're still very entrepreneurial. So I wanted to share some of this with you all because I just looked it up like, an hour ago or yesterday. First of all, enterprise investment scheme, like I said, they like to call things schemes, not plans or programs. EIS. So in brief, you get a 30% initial tax relief. You get no capital gains tax to pay on any gains after 3 years. And if the whole thing goes bust, your exposure is like 38.5% on a pound, which is kind of cool because that's a big incentive, which I think it is, for SEIS, and this targets smaller firms. And issuers that can offer this exemption must be qualified by Asian Treasury relief. You get 50% initial tax relief, so 50 cents in a pound is actually what you're paying for that type of investment. No capital gains tax, awesome, and your loss relief, your max exposure is 27 pence on the pound, which is pretty incredible. And so what's happened is you've had thousands and thousands of companies that have taken advantage of this, and you're getting a significant boost to the innovation sector of the UK, and the UK happens to be the biggest venture market in Europe, right? It leads the way by far. I think it trounces Germany and France combined. And this is probably one of the reasons why this happens. So in looking at this information, do you guys want to, share any of your insights or thoughts or impressions of how something like this could really, I know, Devin, you think, we're going to save the world, but Woody, how would you see applying something like the SEIS program in the United States?
Well, I'm all in favor of these different versions that are out there. I think that the whole idea that if you provide the ability for investors to write off a part of it will drive more into it. I don't think that's the issue as much as we have to get our legislators in DC here on board with it. And I want to share like 7 data points that I have related to that as well, because I think it drives home the message that if we all think that these incentives can help drive the industry and create more value in it and help innovation and entrepreneur and job creation and economic stimulus in our country, that's a good thing. We often think of the Republican Party as the ones that are small business focused and the ones that are focused on the economy. When in fact, if you look at the data, what we did is we took the entire data set of all the companies that have raised money through regulation crowdfunding, looked at all their financials. We capture about 150 data points plus on each offering. 93 of them are on Form C, 58 of them we go and research ourselves. It's fascinating what you can learn when you layer on the 118th Congress on top of where this innovation is happening in the country. And what it shows is, if we all think this is a good idea, then both parties should be on board with it, and particularly the Democratic Party, because here's the first point. For every deal that launches in a Republican district, 2.67 deals launch on average in a Democratic district. For $1 that's invested in a Republican district, $3.33 are invested in the Democratic district. For every one investor in a Republican district, there's nearly 3 investors in a Democratic district. For every 1 job created or supported in the Republican district, there are 4.2 jobs created or supported in a Democratic district. For every $1 of economic stimulus in a Republican district, Democratic districts experience a $4.86 stimulus. 43.8%, and this is the 118th Congress, had at least one woman or minority founder. 44% of those founders were in Democratic districts versus 32.3% of the founders are in Republican districts. So the data shows that, A, this is a bipartisan joint effort when this happened way back when we were pushing for this. B, this is economic stimulus no matter how you think of it. C, if it works for both sides, we should be thinking about how we can come up with these policy objectives to help create this industry and help foster it, because at the end of the day, it's something to do what both parties want.
So it sounds to me like you're expecting cats to sleep with dogs. I mean, you
Well, first I like to eat cats and dogs.
No, okay, so let me be devil's advocate here. Should the government be picking winners and choosers? I mean, should the feds say, well, we're gonna help out these guys because they're not publicly traded? Should we be doing that?
I mean, listen, we got to be honest about this whole conversation as well. The government already does it. So, we have to, you can't just say that, we do it for one part, so we can't do it for another part. I think what we need to be doing as an industry is just advocating for fairness and equality and be like, listen, we have these incentives. We do it with mortgage interest to give incentives to people to buy homes. It exists in other parts of the marketplace. I think it's something we should be focused on here as well. But the reason that they should focus on it is because it's doing what I just said, which is entrepreneurship, innovation, job creation, economic stimulus. Those are the things that our government wants. And this is a way that we can deliver it. I'm going to hand it off.
Marne, I mean, again, you created this monster. How do we make it better? I mean, how can you get something like this, enacted in the law?
So it's a great question, and actually timing is great because we have the 2017 Tax Cuts and Jobs Act has several provisions that expire next year. And that means that Congress, regardless of who controls it, will have to do some kind of tax package. There are some very big incentives that are expiring that Congress can't literally not allow to expire. And this means it opens the door to the kinds of innovations like this, to find new ways to stimulate the economy, new ways to have people invest, and new ways to drive innovation. So I do think the environment is there. It's one of the very few years that it's going to be there. So it's a great timing.
Devin, I'm going to pose the question a little bit differently here because, should government be choosing, winners and losers, but as a subsidy, you're going to, shift limited resources from one side of the ledger to another. Again, I like the SEIS. There was an article in the Times the other day which tends to be pretty supportive of entrepreneurship, and it was critical of it. It says, well, wait a minute, should the government be like sticking its hand in this and mucking things up because you're effectively taking away resources from one place and putting it in another? I mean, what about that argument?
Yeah, I love that question because we're taking the money from ordinary people to do the investment and giving part of it back to ordinary people, right? So you're eligible for this tax credit that we propose if you have an income of $48,000 or a household income of $32,000, right? You can participate. You may not be able to do the full $2,000, right? But you can participate in this tax credit program. So we're not taking money from wealthy people. We're giving it to low-income people, moderate income people, ordinary people. And then we're giving it to small businesses. The vast majority of businesses that are raising on via regulation crowdfunding are not startups like Stephen, right, has, like the clearing bid. They did a Reg CF offering. Those are more exceptions than rules. They're cool, they're sexy, love them, right? But the reality is there are a lot more restaurants, pubs, food trucks that are raising from under Reg CF every day. And so we're talking about shifting capital to ordinary people who look like us, who work hard for their money. And I think that is really, really cool. And of course, let's be really clear, Andrew, we're not asking the government to pick the winners. We're asking the market to pick the winners. There's nothing more Republican, there's nothing more market friendly than saying, market, do your thing. We'll give you a little goose.
Didn't you run for Congress at one point in time? I mean, dude, yeah, you sound like a politician.
Yeah.
I won't hold
Why,
that.
that's what I want to know. Why didn't I win?
I won't hold that against you. Okay, well, let's try this again. The vast majority of small businesses fail, right? It's 80, 90%. They go bust in 4 or 5 years. That's a fact. aren't you just like, taking, good money after that because people are gonna say, yes, I'm gonna dump my money into this business and it's gonna be a home run, and then a few years from now, it just goes bust. I mean, because so many of these companies, they are going to fail, right? Sherwood, Woodie, yeah, come on.
Sure.
Yeah, I don't know.
I mean, the United States was founded on innovation, right? And we have intellectual property rights enshrined in our Constitution. And with that comes the expectation that you're going to continue investing in innovation. And so I think the kinds of incentives that we put in place have somehow, like what he was talking about, the mortgage interest reduction, trying to encourage homeownership. This is just another way to encourage innovation, which I think is very American.
And, Brian, brilliant presentation, I think brought up the point that early on, and the FCC had this in their presentation, is that access to capital is the number one challenge. So I think the argument that just giving money to these companies might mean that they will fail is flawed. I think what we're trying to do here is crack that nut, and help these companies that are promising that don't really have the means or access to capital to actually get that capital from people that are very close to these people. Because in the research that we've done, 80% of the people have a first or second degree relationship to the entrepreneur or the business that's raising that money. And Brian brought it up as well. These are community businesses that are the lifeblood of many of these local communities. And these people want these businesses to survive. In the research that both of us have done, and Brian pointed it out as well, the default rate, the failure rate of these businesses is historically low through investment crowdfunding. So I don't think it's good money going after bad money. I think the logic within the system, when you look at the data, you're seeing the bad deals don't get funded. People are setting these artificially low thresholds for hitting funding targets, but you would be shocked at how many companies just don't raise a dime. So I think the system's working. I think what we're trying to do is come up with ways to help foster that.
Let me ask you another question then. As a subsidy, aren't you inflating the valuation? Aren't you pushing that valuation higher because all of a sudden it costs less to invest? Is that an issue?
No, I think you've got a valid point. I think if we create these incentives so that there's more demand, that will allow these issuers that are artificially setting valuations in many ways to have higher valuations. Now, what I will tell you is the data is already showing an adjustment and a correction in the valuation. And if you break it down by startup versus established business, at pre-revenue versus post-revenue, you'll see that decline that's happening. But I think we need to see if it would happen. I think there needs to be some more logic placed to this valuation side of things, and maybe comps in the industries where people have to justify their valuations would be beneficial there. But did that happen in the UK? When you were looking at your
Okay, then that's an item for discussion because yes, a lot of these companies have failed. Some of them spectacularly so, and some of them have really, hit it out of the park. It's it depends on your point of view, on your side you land on. I would like to interject some of my own opinion here, though I'd like to point out that when you support a smaller firm and you give them capital, access to capital via crowdfunding or whatever, they take that money and they don't sit there and count it and hide it under their mattress. They actually inject that into the economy. So they're buying computers, they're hiring people, they're putting that money to work. And the multiplier effect of that capital going to the economy is not insignificant, and we should never ever forget that. Yes, many of these companies fail, but that's how a market economy works. That's how capitalism works, and it's a good thing because these people that work at these companies, they go out there, they get real world experience instead of going to school and reading about it in a book, and they learn these skills, and if it doesn't work out that first time, so many of them go back out there and they do it again, and they do it again, and they do it again. And then the people that really are successful and they blow the doors off it and they become multimillionaires or billionaires, those are the people that are sitting there saying, hey, I'm going to get back in the game and support these other people. They throw their money at firms that are risky, probably will fail, but it's a cool idea, and that's awesome. We should support that, in my opinion. So, okay, I think there's some good arguments there. There's going to be some criticisms here from the people that are always like investor protection at all costs. I always say, everybody's worried that, you're going to fleece widows and orphans, and there's just a certain element about in Congress that is hard to battle. So let's go back to what the CfPA wants to do, because this is one idea, and Devin, I know you kind of described it, briefly. Maybe you can hit the high points again. I don't know if that's the best package, so I think it's open for discussion, but I know you guys, have a bear hug here, which is fine. So can you highlight that once again, how you anticipate this working?
Yeah, so it would be a very broad and very limited tax credit. So everyone would be eligible for $1,000 of tax credit after making a $2,000 investment via regulation crowdfunding. So the key test is, did you invest in a regulation crowdfunding deal and how much? And you get 50% of that back up to $1,000 tax credit. And yeah, there are other ways to do a lot of these objectives, but we wanted to create something that would draw in the maximum number of people. And I'm not especially concerned about whether billionaires choose to invest their money. Of course they're going to invest their money. It's the only thing they can do with it. You can't spend that much money. So you have to try. But ordinary folks, on the other hand, could spend all of their money and often are tempted to. We give them an incentive to start investing, and it creates a whole new path of wealth to complement some of the traditional things that they're doing with IRAs and 401ks and that sort of thing. So everyone can participate in the entrepreneur economy. We'll all be participants. And I really think we all benefit when we're owning the apartment buildings in our neighborhoods and we're owning the strip malls in our neighborhoods. I mean, if we own those things, it's just a totally different sense of community. We own the businesses, and my gosh,
okay,
it's just so cool.
You're doing a speech now.
Yeah.
Marne, this is your chance to fix what you didn't get right the first time. How do we improve upon, the initial Jobs Act and what Devin wants to do?
Well, how do we improve on it? I think you had an excellent panel of experts a little while ago that gave some very good ideas of what to improve, and you have an 18-point plan here on what to improve.
I'm talking about for the tax exemption.
Oh, for the tax exemption.
CfPA wants to do it, and you have to criticize them.
I mean, it's always the simpler the better, right? Like, I mean, especially when it comes to tax policy. So I think it's pretty simple, right? I think if anything, you can try to adjust it to cap it at a lower threshold to encourage kind of those middle and lower income earners to invest. But it's pretty simple. I think there's not a lot to criticize.
I think in the UK, it's a certain amount of money a year that you're allowed to invest, and Sarah Hanks will correct me later if I'm wrong, and I know that. But I think it caps out, and I don't know if that number is like 100,000 pounds, and after that you can't, start, getting that money back. Why don't, wouldn't that be an interesting way to do it?
I mean, it would be an interesting way to do it, but
It's simple too.
Yeah, it's simple, but a lot of our credits are more of the here is the amount and here's the match to it, so it kind of matches our system a little bit better.
Okay. All right, Woody, come on. What's your magic bill look like? Come on.
Well, I think there's many ways that you could layer on, VCs, that's, as long as VCs are in the deal, so they de-risk it so that you can have that hopeful longevity of it. Post-revenue companies, look at those as ways in which you can mitigate the risk. But at the end of the day, I'll take something over nothing. So I'm with you. I remember when we were walking the halls of Congress, I think one of the things that worked with our framework is 8 bullet points when we showed up in Washington, D.C.
I keep it simple so they can understand it.
And, I think, that when you go with that, it's very easy to build bipartisan support because people can't sort of really pick at it, from one way or another. The more detailed, the easier it is. So let's make it happen.
All right, I am out of time. I want to thank CfPA for pursuing this issue because, again, I support it. I think it's really cool. I may not be in alignment with all the details because it is very simple, but I do think it's something that you all should pursue and continue to pursue. And thank you for doing that. And thank you everybody here for joining this panel. I appreciate it.